I'll start. Hey guys, Rusty Matveev. I'm a co-founder and GP of a group called Current Ventures. We're an early stage fund kind of focusing on the Series A space. Not fully exclusively in the Web3, but very heavy in the Web3 side. Also look at things like media, entertainment, AI, kind of opportunistic, interesting future tech stuff. And also I happen to be an operator in the crypto space as well. I'm the chief strategy officer of a startup called Galaxy. I'm sure we'll get to that too.
My name is John Geenty. I'm a partner at Accomplice Ventures. We invest in everything from DraftKings, Whoop, Klaviyo, all the way to even blockchain things. And so I'm the token crypto guy, pun intended. And yeah, I've been in this space since 2015, and it's changed a tremendous amount.
Great, thanks guys. So you both invest in very different points in sort of the venture spectrum, so pre-seed and seed. And that has changed since you've both been in the space for quite some time. So, what do each of you look for in potential investments in each of the stages you look at? And particularly, how has that changed over time as the space has developed and matured? We'll start with you, Rusty.
Thanks. Good question. Yeah, I mean, it's funny to say the space has developed and matured because obviously it's overall a pretty native space, nascent space. I mean, personally, I look for failure in a big way, right? I look for how founders deal with adversity. It's a little bit tougher in the Web3 space because for a lot of founders, they've just experienced a bull market in a very like sort of inflated, exaggerated type of levels of success, and maybe haven't had the downside of things. So that's a differentiator for me, is to see have you been a founder before, or have you dealt with any kind of failure, and how did you navigate through that? Did you pivot? Do you have a new perspective from that? Like what have you actually gleaned from that experience to now take on to the future? So that's funny to say failure, but that's one of the main things I actually look for.
Yeah, I would say because we focus on pre-seed and seed, we're generally pre-product, or at least pre-product market fit. And so most of our time is spent with the founders and getting to know them and getting to understand if they're the right person or right team for that job. Given the space and its history and a lot of bad actors, you really have to invest in people that you trust and that you are excited to work with, and that you would pick up the phone for at 3 a.m. or tell your wife or your brother or your parents to go work for them because they're great people. And if you're not willing to bet your career on the integrity of that person, given the history of the space, you probably shouldn't invest in them. So I've seen us just lean harder and harder into relationships and reputations that we have high conviction in, because the space is guaranteed to change, and only the people making the decisions at that company will stay the same.
Got it. Just to follow up on that, John, so how are you thinking about writing those bigger checks today, particularly with some of the challenges we face as an industry over the past few years, regulation, some bad actors? What gives you comfort, in trusting some of these founders, and what are some of the metrics you look for? Is it product market fit? Is it revenue? What are you looking for in sort of the later stage?
So the case in my head is, when would you double down on a team, right, that's doing well? And so I really try to look at 3 different things. It's the team, right? Like I just talked about, the people behind it. The technology, so what are they building? Is it tested? Is it proven? And then the traction. Is anyone actually using this thing? Is anyone, what are their KPIs? What do their customer funnels look like? And how is that growing? And then what's the bottleneck to growing that? Is it more engineers? Is it more advertising or more features? What does that actually look like? And so it's trying to find those milestones where, okay, the initial funding is to prove out, we'll say tech, right? And so maybe then you say, okay, we'll do an additional, we'll double down so they can prove out traction. And then from there, you can really get the flywheel going on growing a company.
Great. Yeah, that makes a lot of sense. And Rusty, so as we think about investing in the early stage, as we were talking about beforehand, a lot of the later stage investments, you're able to get some equity, maybe have a path to liquidity, an IPO, or a buyout. It's not really the case in most of these pre-seed stage companies. So you're investing much more in the early stage. And how do you think about when you advise projects, not only on their tokenomics, but kind of go to market, and how do they structure and think about really launching and fundraising for what is essentially pre-product, pre-revenue startups here?
Yeah, no, it's again a good question. I mean, in general, I liked in the pitch, like even the very first pitch, again, maybe a cliche, but I like to sort of see the big picture, right? I want to start with the end in mind. I want to hear, like, we all see the J curve and, oh, we'll be bought for this much money in this company, but really having a vision from the founder or founding team to say, like, this product belongs in the space. There's a huge need for it, and whoever so-and-so wants to buy this product will want to buy this product because it's going to be a necessity. There's that angle for sure is part of this. In terms of the tokenomics, I mean, everything is very, very different depending on the use case. I mean, we've all seen tokens out there that have no utility and they're just sort of hype and attention and meme coins and that kind of stuff. And then we've seen things that truly purely have some kind of intention. So it's hard to give like a one sort of binary answer to that specifically to that, but not over-engineering the overall, not depending. Also, sorry, one more call out there. I've seen a lot of projects put a ton of resources and time and capital into their token structure, into launching their token, into the foundations that you have to launch. And I think that's something that everyone that's founding companies now will benefit from because it's not net new. I mean, yes, we're still operating in a little bit of a gray space and launching foundations in the Caymans and whatever's happening, but trying to jump off of that and take advantage of like the last decade or so that companies have been doing this. So again, there's no right or wrong answer. It's more so like, is there a vision and utility for the token? Is this token even required? And again, completely different answer for this is a meme token, but usually we're not investing in that space.
So this question for both of you guys. So the meta in the environment is this low float, high fully diluted valuation sort of launch for these tokens today. And the gold standard used to be, hey, let's get a Binance listing, let's get a Coinbase listing, and our token will go up, and we'll eventually have the unlocks over time, but we'll settle in at a reasonable valuation. As we talked about, I think most tokens that launched on Binance this year are down, about 90% of them. What's the sort of best way to think about token launches in this sort of environment? ICO, return to ICOs? Is it other distribution mechanisms, or is it we're not going to do things the right way using the token mechanism through a fair launch in this ecosystem? Maybe we'll start with you, John.
Yeah, I think to get to more of the fundamental question, I think that, again, you should only use a token where it makes sense for your business model. At the end of the day, you want to have some, ideally, open source software model where you have a token that accrues value to those that use it or contribute to the software, something like that. And I think what we've seen a lot of with these token listings that have done the march to zero in the past year is it's simply an expedited cap table, and people are just rushing for liquidity. And instead of it being the beginning of a token's journey when you're listed on Coinbase, it's now almost become the end of it, right? And so I think that that's gotten fairly toxic, and you're starting to see more of these fair launches, which are interesting because there's no VCs involved in it, right? It's generally you go and you stake ETH and you earn this token, and it's a linear unlock, so no one feels like they're, no one feels like they're the bag holder at the time that things go liquid. So I think getting community alignment is very important, and I don't mean that in like a meme way, community alignment. I mean it in an actual like long-term value to those who are contributing and using it. But part of the reality is that you're seeing a lot of these tokens do this kind of listing with that dynamic because founders that raise with tokens generally get a premium over those that don't. Because you're seeing a lot of investors who would pay almost 100% premium for a round that is a token round as opposed to an equity round, right? A $10 million seed would be a $25 million token raise. And that's just the reality of it. And there's a lot of bad dynamics that go with that. So again, if you're going to do that, you should just make sure that it makes sense to your business model and it's not just a cash grab that's going to hurt the investors at the end of the day.
Rusty, anything to add there?
Yeah, no, good jumping off point. I think it's an opportunity for a founder to really demonstrate their sales and marketing skills about building in community. To John's point, if it's not a fair launch, which I think is definitely a good model. I remember our CTO at my startup, the crypto startup, definitely wanted to do that, and we were in the bull, and we had a lot of demand from investors, so we didn't go that approach. But like if you came to a seed or pre-seed or early stage investor, and you were able to demonstrate we have this many community members or this much pre-sale, or we've already sold this many tokens, and now you're coming into the game. There's that's again an opportunity for a founder, so that's excellent. take it one step further. If you could, if you're building a play to earn gaming company and you're able to align with like an Animoca Brands or someone that's in the space that that it's going to affect their portfolio, and there could be a lot of synergy. Also, great value, great demonstration to to show other investors, and even again the invert of that, of showing the community, look, we have these groups involved. This is gonna be part of the gas fees or whatever. Again, whatever the tokenomic dynamics are.
Great. So let's pivot to markets. I think we all are waiting to see you guys shine off your crystal balls and give us all the alpha for the rest of the year. So, how do you see the current state of markets for the rest of 2024? I think we've all been waiting for the Q4 bull market that everyone's loved to talk about on Twitter and other forums. But how do you see 24, 25 for the market, your projects, and the business in general?
I'll start. Let me take out that crystal ball. We're in an interesting period, of course. There's a pending election, and that will help determine some of the stuff one way or the other. Just by nature of where I'm sitting and my biased lens, I'm optimistic in general, right? I don't want to advise anyone to go and put out their life savings into meme coins or into the crypto market. But in general, I'm bullish. I think that even though there's going to be cycles that come through of turnover and all that stuff, even maybe with like layer ones, I have conviction that there's necessity for this technology and for these markets, and so I think that it's going to all come up, whether it's in 25 or beyond. One of my partners does a lot of writing on this space, and whether it's just hyping up and saying every day it's the bull's coming, the future is here, and all that kind of stuff. But I think there's going to be some consolidation, perhaps some full turnover, and again net new coins, or even perhaps layer ones. But in general, adoption will come, whether it's through institutions, whether it's banks and political processes and sports and fan engagement and all the retail, all the things that we've even seen, like the Starbucks Odysseys of the world that have come and gone. They will come back. Like there's too many good use cases and too much potential for better efficiency and better more upside for all parties involved for it to just go away.
Yeah. So I think, given the regulatory ambiguity, there's a lot of good opportunities out there because people are fairly risk-off into the election. So that's one area that there are a lot of things that you can look for and find some value, dare I say. And on the other side, I would try to avoid those sectors that are overhyped and overheated. You really don't have to name them out loud because everyone knows them. And I think one of the undervalued areas are those that are tangential to the consumer use cases, right? A lot of things about personal data, things like that. Just because there hasn't been a tremendous amount of monetization around them, I think doesn't mean that it will never happen. Mm-hmm. I think consumers are getting more and more aware of privacy issues, and you saw the Telegram CEO get detained in France, and I think people are going to become more and more aware of some of the issues around that, especially as AI gets more prevalent and the context of your data defines how your queries are returned, regardless if you're looking for news or looking to buy things online.
So just to double click on that, what are areas you guys are encouraged we are seeing product market fit? I think stable coins are basically the only thing that has somewhat of a product market fit today. Meme coins, as you mentioned, Rusty, maybe we call that product market fit for gambling. What are other things you guys are excited about specifically in the next 18 months or so you see could start to catch on?
Do you mind if I take that?
Yeah, please.
One thing that's really interesting is on-chain attestations about attributes about users or things, timestamps, proof of completion or something like that. A good example is, I don't know how many people use Strava or the running app. There's an application called receipts.xyz, and you can go and prove on-chain that you did a certain workout, and you can have a leaderboard with your friends or family, and it keeps you accountable that you actually are working out. Something simple like that adds a social dynamic. And one of our portfolio companies is called Icebreaker, and you can essentially create a profile of all of your different pointers of attestation, right? So your GitHub or your LinkedIn, or proof that you had a meeting with somebody, using all these different Ethereum attestation service integrations. And I think that in the future, if you're looking to fill a remote role, it'd be better to say, okay, I'm just going to search through this, find people that are first or second degree contacts that I can actually get the proof that they contribute to open source projects. Right now, if you get a resume, there's a lot of faith that what you're reading is real and true. And if they got that GPA or went to that school or worked at that employer, like unless you're going to call and check and call the registrar at a school and confirm grades, that's a lot of work. And it would be nice if you could have pointers from oracles that verify those kind of things, whether it be on for recruiting or for investing or even on a dating app, right? Mm-hmm. I would love to say I was 6 feet on a dating app, but that's not true. And someone might feel like, all right, it'd be great to have verification of that. That's a joke of a use case, but in all seriousness, you can do more of the verify rather than trust on third-party transactions online.
Yeah, it's the other acronym for VC, right? The verified credentials. That's definitely a great use case. We all remember the days of sort of the single sign-on and the like the sign-in with Facebook and the pixels and all that stuff. I think that's naturally an opportunity. It's a really interesting dynamic or like double-edged sword because anonymity is pretty big in this space, and so it's like this balance of transparency and anonymity. The idea it can work in both ways. And in terms of your question, Tom, I mean, you mentioned gaming. Obviously, is a really low-hanging fruit one to point out to the whole earn to play or play to earn. I think I heard someone say on a different panel, a company called StepN. They're talking about a company like Sweatcoin or the fitness economy. So very similar to what John was just saying, where you do a workout and that's proven, and you're able to check in, and whether it's working with with a Whoop or with one of those types of companies that's tracking you really get to have that attestation and proof. I think that's a great use case. The gambling world, there's there's use cases across the board. I love this, like the retail space. So, I think that makes a lot of sense. Endless possibilities.
Yeah, there's a lot of possibilities. I think people have been calling for gaming for quite some time. I think we're all bullish for a few games that are coming this year. And, it's interesting you mentioned StepN and some of the fitness apps. We met with a company the other day. I was thinking, oh man, Sweatcoin really hasn't caught on, but this country, India, had this app called GrowFitter that had millions of users. Mm-hmm. I'd never even heard of it. I was like, wow, okay, maybe we're more geographically diverse than I think we remember. So I want to leave time for questions for the last few minutes, but just one last question for both of you, and feel free to take it or pass. Love one non-consensus thought, opinion, broadly about the space, about verticals, about projects that you see a lot of folks talking about that you would push back on or take the other side of. And I'll open it up to either of you to start, or we can pass it on to questions.
I can take that. I think people are always saying, oh, you need to make the user interface more human-friendly, right? Better user interface, because right now it's terrible. But I think if you look ahead and you follow the thread of, okay, if you have autonomous agents interacting on-chain, should the interfaces be optimized for humans or some kind of programmatic actor, more of like a CLI or API-style interface? And so I think you have to decide whether or not, as a builder, you want to build for humans or computers. And I think that you'll probably get a lot more usage if you're building for things that don't have to manually click, right, and don't have to visually see things and can just read through your API endpoints. I think that's a general non-consensus view, because you often hear how people say you need the killer consumer app, but I don't think that's really how you're going to scale usage for maximum throughput.
Yeah, that's great.
I'll give you I laugh because the user interface thing is one of the first things I was actually going to say too. A little bit of not too much contrarian to what John was just saying, but depending on what you're building and where you're at, a lot of people in the space are, call them degens, or really in the space, and so like that user experience is just sort of secondary. You see all these like sayings of how do we onboard the next 100 million or billion users. I think a lot of it is familiarity. A lot of it is actually closer to like, can you get use cases that people are comfortable with and used to, and can you get the crypto out of the way? I mean, that part maybe is not super contrarian, but in terms of like on a daily basis or on a weekly basis, the amount of decks or pitches we hear and see, there's way more that are super in the weeds and like in the Web3 crypto space and addressing that demographic versus trying to, in fact, even the groups that are saying we're trying to do a Web2 or consumer-facing thing, they're not building it that way at the very least. So I personally still think that that's a necessity, and again, not a super contrarian point, but I think that is in fact still the path if you're building consumer-related stuff, is to actually get out of your own way, get it out of the way, and then put it in the background, and make it just super frictionless for people to use. It doesn't matter if they've never heard of MetaMask or know how to use a wallet. Make it Venmo, make it super easy, etc.
Yeah, two fantastic points. Love to open it up. We have 5 minutes left here to questions from the audience. We can navel gaze a lot here, or just go questions. I'll start with the front. Or did you? Oh, okay, perfect. Yep.
Thanks for the talk, by the way. How do you establish valuations? I know there's a negotiation involved, but pre-seed, seed, it seems like it's pretty difficult to do that.
Good question.
Yeah, I think it comes down to, what's that? Let's talk about pre-seed. I think that's the easiest one. What's that founder's reputation? Do they have a good track record for executing? Have they had positive exits in the past? What's the what's the market generally look like at that time for that kind of thing? So it is more of an art than a science in that way, but it's very much based on the experience of the founder, their track record, and the confidence that you have in the team, and how much of the company they want to sell.
Just to add to that, it's very market dependent as well, right? Things that were selling seed stage, fully diluted valuation at 25, 30 million valuation, suddenly we're 50, 60, 70 as the market ticked up. So it naturally is a comparables game, for better or worse, even though sectors, projects, teams could be very different. So it's fluid dynamic, and depending on tokens and equity. Good question, though.
How's it going, guys? My name's Calvin. Thank you for your insight. I have spent the last year watching a crazy number of low float, high FTV, VC-backed coins just go to near zero. One tip to look for token distribution is leveraging existing communities where you use on-chain analytics to see how long certain assets were held. And some of the most successful launches we saw through the bear market were through that type of fair distribution. I did have one a little bit silly question about meme coins, as they are clearly what the market has shown us they're the most interested, and we all know the market is never wrong. It seems like an opportunity for me to regain trust as a VC or build up your mind share in this growing market if you were to put support behind an existing community like that. And I know you don't get in early, you won't have the crazy gains, but beyond the economic value, it does seem like that is where most interest is going if you look at the liquid. So I was just kind of interested on your guys' take, and if you see any opportunities within meme coins to kind of reach out to the people and the communities who are participating and having fun with these things.
Yeah, absolutely. I'll start with that one. So, again, I sit in a little bit of a unique position because I straddle both the investor side and the operating side. We're talking to a lot of meme coin projects, actually, and it's kind of even difficult to say that we're talking to them because a lot of them don't have a central, there's not a CEO necessarily in those types of things. But we're talking to those communities or like the leaders of those communities and quite frankly, trying to bring utility and some transparency to those, to those communities. Again, a lot of times the sort of myth and the aura, no pun intended on aura token, but the myth and the aura of those things are in fact the fact that they're again anonymous. But can we give some snippets of content, even of behind the scenes of some of the intent? Can we, and more importantly, again on my operating side, can we bring utility? Can you buy coffee or buy some some experience with a meme coin versus just purely trading on the hype? And I think that's seemingly again a first principles easy approach to take to where can we make it applicable and acceptable in a ubiquitous amount of places.
One more with a minute and a half here left. Yeah, sure, go for it.
Here you go. Hey, guys. My name's Steve Leahy. I got a question for you. If you were in an elevator with a chief investment officer of a 9-figure family office who does not invest in seed stage crypto venture funds, what's your 30-second pitch? Why is he going to cut you $2 million?
You want to start like that?
Yeah, I think that venture funds get paid to take extreme risk. So, if you're looking to have a 10-year fund and 50x that, you should look to venture. And so I don't know if that's what a CEO would look. Do you say CEO or CIO?
CIO.
Yeah, I would say just look at our track record, right? We were seed stage in DraftKings, in Whoop, in Klaviyo, and we've had a consistent. Our methodology is take large bets early, and if they're winning, continue to compound in the winners. You don't write lotto tickets. to the meme coin question, we wouldn't do anything we didn't want to hold for the next decade. So unless Shiba Inu coin has a great roadmap and founders that aren't anonymous, I don't think we would touch it. But yeah, I think it's more of a game of getting to know the companies extremely well so that you can compound in one winner that you're early at 40% CAGR rather than praying and spraying a tremendous amount of lotto tickets.
Yeah, I'll add on to that real quick just to say, first of all, I'm personally not an exclusive Web3 investor, and so diversification has to be part of this, right? I would not recommend a Web3 only approach, at least as for myself. But at the same time, this is the Wild West, right? And in a positive way, this is one of the only sectors where you can really gain insane multiples in a very short amount of time. Like not a 10-year horizon. I wouldn't pitch it in the sense of saying, hey, well, we'll give you dividends in 6 months, but you could really get your initial investment out in a much shorter period of time and just ride the upside and still enjoy the access that we get across the Web 2 and Web 3 verticals, and take it on. It's a sector you shouldn't ignore. That's at the very to say that at the very least, and you're not going to see that kind of multiple in very many areas. So like this, you have to pay attention.
Unfortunately, I've had too many of these conversations being a former investment consultant for pensions, endowments, and foundations. And I think it comes down to you own tech in your portfolio, right, Mr. Portfolio Manager? Okay, it's a significant portion of your portfolio. Great, but you're ignoring what could be 50% or 20% or even 10% of the technology economy for the next 20, 30 years. And if that's going to be your bet, great. That's probably not a great career bet. But even if you totally disagree and you want to make this a 1% position of your portfolio in the venture bucket, the TVPI, all the IRRs, the returns in the crypto sector have outperformed just about every other venture sector to date. Will they continue to do that? Probably not to the same extent. But certainly there's a lot more opportunity in a sector that's growing much faster than these other sectors. So it's a nuanced argument, and you're going to get a lot of no's. But I think we're all here, and that will eventually be right in sort of that argument. So I'd like to thank the panelists here. Thank you guys for joining us, and great to